Well, next up, guys, we have from CNBC, the Federal Reserve holds interest rates steady, and here's what that means for your money. So, surprise, not surprise, the Federal Reserve was like, yeah, we can't reduce rates. This is... I'm going to say crazy because that might sound overinflated, and it's not. Our Fed rate range is still 5.25 to 5.5, and it has been since last July in 2023. The Federal Reserve held rates steady at the end of its two-day meeting last Wednesday, once again pushing back the start of rate cuts and any relief from sky-high borrowing costs. And higher prices and interest rates have put many households under pressure. No duh.
Hello.
This is them, I'm going to say, publicly eating crow, and here's why. There was so much talk at the end of last year in quarter four. Oh, rate cuts in 24. I think we're going to see numerous rate cuts in 24. We were wagering on the show. It's going to be 1 to 3, 3 to 4, 6 to 8.
Memo still stands corrected.
No, but Andy, remember, they were talking about, like, financial analysts were talking about we're going to have 5 to 6 rate cuts.
There's no way.
Yeah. And we all came down to, I don't remember. I wish I could
I
go
said
back
3.
and remember.
I said 3.
Okay.
I thought there would be 3.
I don't remember what I said.
Obviously, that's not the case. I mean, they're saying there might be one. There might be one this year.
Especially when, Jerome Powell came out and said that the Biden administration is cooking the books. Right?
Well, that's another problem, too.
That was crazy. I never thought I'd hear that. That
was way to unpop the lid on that one.
You're talking about the employment part, right?
Yeah, correct.
And
because it all has to do with jobs.
And that's a little bit of a clapback, too, because, you're not really like, the Fed's not really working for the government, but there's like persuasion, and they are kind of doing some things, and they're kind of not. So it's kind of like they get to pick and choose where they want to say, oh, yeah, we're hand in hand. And then they get to like lay blame when it's not in their favor. Like, hey, get that off me. Don't put that on me.
You guys got to admit, that was pretty crazy.
That wasn't that. Was.
For him to just say, hey, the Biden administration is pretty much cooking the books. They're not really looking at the employment rate the way they should be. Otherwise, we are not where we're supposed to be at.
Well, the whole gainfully employed definition has been changed, because now you're talking about creating new jobs, and there's all these new jobs. But if you have 2 of those, and you have 3 of those, and I have 2 of those, that's still 3 people employed. That's not 7 people employed, and that's the issue.
But they have 7 people.
So when you say we have 7 new people that have jobs, it's you have 2, you have 3, I have 2. That's one of the issues. I'm not going to get into all the issues. That's one of the issues with the counting. And I'm also not going to say that other administrations don't do the same kind of garbage. They do. It's what do you got to do to make it look certain way? Jerome Powell's like, hey, I ain't having none of this right now. I ain't having none of this right now.
The more I listen to the Fed, is the more that math is just magic, not science.
and here's the other thing I also want to make sure I really dislike that people who are incredible or should be in credible positions say things that are incorrect.
Yeah.
So we have Greg McBride. I'm sorry, Greg. Bankrate.com. Quote, it is not enough that the rate of inflation has come down. He's saying come down in positive territory. If inflation is +3 and it goes to +2 or +0.3, +0.2, it's still in positive territory and growing. It's slowed down, not go down. Do not tell people it's gone down when it has not gone down and is just slowed down. Again, I'm going to go to the weight metaphor. If I go from 200 pounds to 205 and then to 209, my weight increase has gone down from 5 pounds to 4 pounds, but now I'm 209, not 200.
Dang, yeah.
That is not going down.
So way to break it down like that.
I hate that, and then tries to backstop with, well, but prices haven't, and that's what's really stressing household balances. Like, no, you're already misinforming it in the way you're saying it. It's not going down; it is slowing, but still increasing in total.
Well, we already know inflation's there. I mean, I went to Carnival to go get some tortillas and churritos and some cheese. I walked out of there, it was like $89. I'm like, what?
Hey.
And I just got a little. The little carrying cart.
It gets pretty expensive.
You know what I'm most impressed with this part of the show is you moved away from the $1 menu at McDonald's and you moved away from the Jack in the Box tacos.
I had to go there to shop for Tanya. It's my birthday, so I had to go buy a couple of things for myself over there, and I was pretty surprised. I haven't done some grocery shopping, even though it was just the little basket things,
little tiny hand
basket. And it wasn't even full.
He's like, they had these things that's like a little mini cart, but we can walk with it.
Yeah. So I understand inflation's still up there, so I understand that.
So interest rates for
last time I bought milk, there was $2. I went, it was $5.
$2. No,
I haven't seen that.
No, he went to go get milk and never returned.
Yeah.
So this is going to impact everything, guys. You got credit cards, mortgage rates, auto loans. What else we got here referenced in the article? We got student loans, and savings rates. So Look, if you got a lot of money, you want a good APY on your savings, you can put in a CD for 6 months, 12 months, get a good return while the Fed rate's high. You might as well do that. You can at least get a return on your money that's outpacing inflation at its current rate, so that might be helpful. If you got $100,000 or more than that, just go dump that in a little short-term CD. That might help you out.
Credit cards, I did see the credit card debt still going up over 1.3 trillion. Never seen that.
So crazy.
It's crazy.
That's absolutely nuts. And again, I think that some of the things that Jerome Powell is saying, and evidenced by the credit card total volume going up balance-wise, that's indication of other things brewing under the surface. It's obviously reflecting in these numbers that something's going on, and people still have to spend. But I think the problem is that, maybe, I know this is maybe a little on the ground reference here. I don't know where this might be in the data, so there's my qualifier. But I know that for a lot of times, people would rationalize using their credit card to spend things discretionary. I want to go take this quick 3-day weekend. I want to go buy this Wave Runner or whatever. But now it's more towards like, I need to use my credit card to pay the things I got to buy. I got to buy groceries, put gas in my car, and do those kinds of things. And it's not necessarily discretionary. It's more like the necessity. And that I am seeing just observationally when I'm out and when I'm talking to people and I'm hearing, I think that's been the broadest change that I've noticed firsthand. And I think that's obviously pushing some of these numbers.
Yeah, that's all the data too. We're seeing in the data there. We're seeing some of the highest auto repos now.
Oh yeah. I saw that.
And people are, why is that happening? Because the necessity maybe for 2 cars or 3 cars is not in right now,
Yeah.
Some people are just going to 1 car. I know I've gone to 1 car.
Mm-hmm. Yeah, that's right.
Same.
So
yeah. We got rid of one of our, we have more drivers in our house, but we went from 3 to 2 because 2 that paid her off. And I was like, the one that's got the payment, you're gone.
Yeah,
I don't need it.
Exactly.
I don't need it. So.
But some people, they don't have the luxury of getting rid of that car. They just can't have that payment. And so they do have the necessity of 2. And so now they're losing 1. They have to try to figure out how to just even keep 1.
So here's the thing I'm going to ask you guys. If you think that, let's go back to the kind of the main point of the article was the Fed's going to drop the interest rate 1 time. First of all, 1 time? Like really? Wow. Okay.
Yeah.
But then what's that going to mean for people? Like how long do you think we're going to continue asking people to go through this trudge, for lack of a better term? How long do you think this is going to go on before we see, let's say, a real settling in with prices? Because I think prices are already fixed.
Yeah.
My proposal or my projected estimate is that we're going to be in this all through 25 and into 2026. That's
I agree.
What I think.
A lot of people think presidential is going to come in and it's going to, whoever comes into place is going to, change is going to come immediately. No, it's a ripple effect.
Yeah.
You throw a stone and then the ripple, you'll see it. It takes time for us to see that change. So for me personally, I think after going through all of this, we're going to see a recession.
Yeah.
We're going to hit, it's going to get tougher.
Mm-hmm.
That's what I feel.
How long do you think it's going to be tough?
For at
What's
least,
your estimate?
my estimate would be where things kind of start breathing, it's going to be towards the end of 2025.
Okay.
It's
That's where I'm at.
12 to 18 months.
Yeah, 12 to 18 months.
Okay.
More like, I'm going to say 14 to 18 months is where I'm at.
All right. That's good. Brian, what's your take on that?
Yeah, I think it's going to get a little bit worse before it gets better.
Okay.
Based on everything that we've been talking about, seeing the data, the Fed, and just, the way that people are, moving, I think we're walking a very fragile line. And a lot of people are still, like I said, putting that credit card, putting those costs into their credit card and just racking it up. And I think that there has to be a breaking point. They can't just continuously be spending. And like we talked about, episodes back in years, I want to say close to like a year now, where people are going to start saying, well, hey, I don't need that much. I need this the most. So, hey, we're going to stop, paying this. Might be one credit card. That one credit card then turns into another one, and then a car.
Oh, yeah.
And then your house is the last straw to fall. We're starting to see the straws fall from the auto repos, the high credit cards, and those are just literally like foreshadowing of like, hey, what's to come. And if it doesn't get any better, well, a lot of people are going to have to then start resorting to not paying their houses.
And I know there's some chatter we've had with a couple people too, kind of off camera, like the NODs are kind of showing up a little bit. Yeah. They're not like crazy, but they're like, hey, there's a little bit of an uptick recently here in the spring of 24, which again, maybe that leads to inventory, but maybe someone can save their place by selling it before it gets too out of control. And that's what I was
going to say. Maybe, there is still so much pent up equity that can, basically if you unlock the equity, you might unlock the real estate market, but everybody's still holding on to their low rates. because at the same time they don't know what's going to happen, and they're like, if I go sell my house, now my payment's up and I lose my job, now I got to twice the payment, and I don't even have the job to be able to pay it anymore. So it's like, on one hand, I understand people want to move, but at the other hand, they're like, I don't know what's to come, so I can't really make a confident decision.
How do I plan for that, right?
100%. So a lot of the people that are transacting are people that, hey, in the moment that it presents itself, I need to make this move. I need to move. I move. Because if not, people are like, hey, I have a house. I got a low payment. I could think about moving. I don't really need to. But the people that got to go. I mean, they're stuck trying to find houses.
Well, then maybe, so I think then my summary point for the time frame is that during this duration, these guys are talking about, talking about maybe 25, 26. I think what we need to tell everyone is not only buckle up, but be prepared for the Fed to continue moving slow. Because even if the administration changes, if the Fed is saying that they're going to only do one rate change this year, it might mean they only do 2, 3, at max, maybe 4 in 2025. But again, if they are data dependent, guess what? All that data has to then work in the favor of those choices. That actually could be a much longer time frame than we're actually thinking about right now. So just be prepared for that.
And even if the next presidency wanted to come in and say, hey, clean slate, new Fed president, you can't. He's termed in.
Oh, yeah, he's termed in. It takes a while to replace.
You can't.
And even if you just try to tank that, again, there's repercussions. If you just, instead of like that pebble hitting the water and rippling, if you throw a stone in it, that makes it, that can also cause some other problems. So let's not hope for that either, I don't think.
Yep. I mean, and there's a lot of stuff going on our economy that just
it's going to unfold right before our eyes.
There's just so much stuff that's intertwined with problems overseas, with immigration here, the border. There's so many things that are critically connected that it's like you can't move too quick on one thing because you might break another.
Well, that's what I heard. I heard everyone's coming here for high interest rates.
Yeah, exactly.
Okay, we got to go on from that one. That was terrible.